everybody. Welcome back on another episode of VCTV, which is the Venture Capital TV. Myself, Sunny Mohanty. I'm back. I'm back on VCTV today to host a topic to discuss about how to find funding for your startup. I'm very excited to be back online after a week, 10 days break in Dubai. So I'm very excited to discuss and speak with my speakers as well. So let's just get started. Hey, hi Anil, hi Tushar, hi Vandana. How are you all? Long time. It feels like, I was away forever.
All good.
All doing good, Sunny.
And
yeah,
good to be, back on, Lot Open TV. It's very refreshing and good you are hosting. So welcome back from Dubai.
Thank you, Anil. Thanks a lot. Okay, Tushar, you wanted to say something?
Yeah, I want to say that I was out of action, but I was forever connected with the VCTV, watching it, and also watching your trip to Dubai. So that was another experience in itself. So now it's good you are back, and coming on this show with you as a moderator, it's always a pleasure. So nice. Look forward to an enriching discussion.
Awesome. Thank you, Tushar, and welcome back as well, because you were also away for a long time. Thank you.
Thanks.
Okay,
Thanks.
Vandana, how are you?
Welcome back, Sunny, and really nice to see you, safe and fine. And I enjoyed all your photos and videos about the trip. And it feels like I have not met you since really long, and very excited to be on the first day of June here on VCTV today.
Okay. Exactly. I was also missing you guys. I mean, it feels like really, as Vandana said, it feels like over like months and months to be not on VCTV. Somebody else has joined. Harsh has joined. Hi, Harsh. You are.
Hey, Sony.
Hi,
Hey, how are
Harsh.
you? Well,
Hey, I'm good. How are you?
Hi, Harsh.
hey, I'm very good. Back from Dubai in quarantine in a hotel now.
We are seeing your Facebook lives.
Yeah, that's the whole idea about Facebook Live, to show the world.
Show off.
Gary's joining us. Oh, you can say show off or just, hi, Gary.
Hi, Gary. Hi.
Hey, Gary.
Welcome back.
Hi.
I came back. So welcome back. So let's have a quick round of intro. Start with Gary Fowler. Hi, Gary. Good morning.
Good morning. How are you today?
I'm very good. First day of quarantine starts today for me in the
You
hotel.
look like you're in a hotel room somewhere.
Yes, indeed. Indeed, I'm in a hotel room in Singapore.
Oh, wow. Great to be here. My name's Jerry Fowler. I'm a serial entrepreneur and investor. Done 17 companies, 2 unicorns, involved in the original management team of Click Software. Sold to Salesforce for $1.35 billion. And also Eva.ai, an AI HR tech company that I co-founded how many years ago? 5 years ago now. Forget. And also GSD Venture Studios, premier AI and quantum venture studio located in Santa Clara, California. And also a GSD SPAC, which is our new project that we're working on. Love AI and quantum, and it's great to be here with some friendly, smiling faces. Right, Vandana?
Yeah, Gary. Thank
Thank
you.
you, Gary.
Yeah,
Thank you all.
thank you.
Let's have a quick round of intro from Tushar.
Myself, Tushar Kansal of Kansaltancy Ventures. In my previous life, I've worked for Deloitte and Touche, Brand Capital, which is Times of India's arm, and also headed treasury at a Russian telecom company, MTS, and was CFO with the logistics company owned by Guggenheim Partners. In my past 7-8 years, I mostly help startups and also allied with a lot of venture capital investors in India and globally. And it's always a pleasure to be on this show. So look forward to an interesting discussion. Thank you, Sunny.
Thank you, Tushar, and welcome back. Next, we have Anil. Hi, Anil. How are you?
Hey, hi, Sony. Thanks for having me. I'm Anil from Unicorn India Ventures. We are Mumbai-based early stage fund. Currently, we are in second fund with AUM of around $80 million. The portfolio of 25 companies, and we also have a small fund in UK, portfolio of 7 companies there. We invest anywhere around half mil to 2 mil, in early stage tech companies. So thanks for having me. Look forward to share my views.
Thank you, Anil, and welcome back on VCTV. Great to have you all. Hush. Hush, you're
Yes,
mute.
you're muted.
Yeah, thanks. Sorry for that. So glad to be back and glad to have some familiar faces over here. Just a short bio about myself. Worked with typical, corporate cultures first. Distillery, Johnson and Johnson. Worked with Paytm. Then I'm currently working as a venture partner with our ventures and also a founder of Startup Hackers right now. Right now, I typically help startups raise funds all the way up to $10 million, and additionally, my Facebook group called Startup Hackers. I'm kind of mentoring and guiding early stage startups to kind of grow and scale that they can take it to the next level and internally collaborate among themselves as well. So thank you so much.
Okay, last panelist, Vandana.
Yeah, I want to thank Sunny and Latupun TV for having me here over and over again. I was in Singapore and Jakarta for 15 years in investment banking. I had my own family office fund there, and this is my 7th year back in India. I did some investments and then I went back to advisory. So currently, I'm connected with 300 investors globally. We pick up global deals. We are sector agnostic. Typically, we do $1 million to $25 million, and I've given 150 talks all over the world in this year. This is the 151 which I'm having today.
Great. So I think all of you have a lot of experience working with startups. All of you have a lot of experience raising funds for the startups, and helping them scale as well, and helping them connect with the right partners along the way. So is your startup moving towards the critical point of needing funding? I'm sure everybody must have started at a point where one of your portfolio companies might be raising the first round, like the seed round or the pre-seed round. So what are the best practices? Like, let's just start with the basics. How many of you have helped a pre-seed or early stage startup to raise funds as a part of your portfolio? And what were your best practices in doing so? Let's start with Anil.
Oh, thanks. I just concluded one transaction where we had invested last year when we went into lockdown, where we made a seed investment, and the company had tracked well. Uh, for subsequent round, I think what worked for company was their ability to get traction, right? Traction, and that too of multiples, right? Attracting good customers, working on patent, building on team, and showing a promising growth, what actually worked for them, right? So in my view, going for subsequent round, it's always help, if you have a reference. Of course, we were instrumental in making connects, but what worked for team was their ability to you know show promising startup, and they were very upfront. They never shied away from accepting their weaknesses, accepting, acknowledging their strength, and always were ready with numbers. Not on single call, I found them telling that, or bluffing, which most of the investor hate, right? You need to be transparent. Nobody expects you to know all the answers, but I think doing your homework always helps. what worked, for them. So this was the fastest, possible round we could close. We just made introduction and 2 weeks flat. The round was closed. Now we are almost at the fag end of documentation, and in not in single call, like the founders had done their homework. They were ready with every possible query. They were, even had done their homework on competition. They had even done, on future of technology. So I think knowing what you do always works for you. These are the few points, I would like to share, and I'm sure my friends will share more about, their experience.
Yeah, sure, exactly. Understanding your business is the key. Tushar, what's your insights on that?
So it's generally, the view which whenever we have discussions with investors, and it's like you are always betting on the founder first and product second. So that's a kind of thumb rule kind of a thing. So at least for me, it is like that. So, and the earlier you are investing, the more you are betting on the founder. And then what matters is the integrity of the founders, not only in terms of what they are disclosing, how correctly they are disclosing, but in also in terms of their understanding of the sector, and understanding of the business dynamics in which they are operating. And so for me, integrity is first. And if at all they end up creating a wrong product, I'm sure if they are uh, they have the requisite skills and integrity, they will end up bettering the product or creating a new product. So in early stage investing, one has to find hustlers, and people who don't give up, and keep on hustling it out. I'll give you an example. There is this 2018 pass out aviation engineer from Moscow, and he is the CEO of an aviation academy which is being set up here in India. It's project which is more than $5 billion project. And this guy, there are some guys you just see and you say that I would like to put money on this guy, because he would never give up. He wanted to have a meeting with the civil aviation minister. He couldn't. Somebody gave him wrong information. He just went to the political constituency of the minister, met the party guy, had a good dinner with him, and in 2 days he was sitting with the civil aviation minister. So people like that you want to bet on. And especially in today's times, technology is something which matters a lot. And so probably someone who really understands the core technology in which he's operating. So these are the factors which I would see in terms of pre-seed and early stage investments. Thank you.
Right. I mean, that person is a go-getter, right? Thank you so much for sharing that example, Tushar. Thank you so much. Harsh?
Yeah. So both Anil and Tushar made some very interesting points, right? One of the other things which I typically look at is obviously at this stage, founder is the most crucial, right? Additionally, when they are presenting it to me, the most important thing which I look at is where is the traction in the revenue slide, right? If the thing is, if they don't have traction and revenue upfront, they tend to hide it in the end, or sometimes they don't even keep it. So that's a huge red flag. If you have amazing traction, you have kick-ass revenues, that is something you should show about right in the beginning, right? So any fundraising mandate which I'm working with, I want to make it a point that that the revenues and the traction has to be number two or number three slide. You need to show what your current position is, how much you've already gained in the market. So because coming back to Anil's original point, if you are unable to grow your business, or if you are unable to show the traction, if you're unable to show revenues in the business, then it's a huge red flag, right? You can make all
Yeah.
the fancy amazing things, but if people are not going to pay for it, doesn't really make any difference. So I prefer startups who have that thing right up front, because then it gets an interesting story that yes, you've already done the groundwork, you're willing to do the hustle, and you're willing to tell it upfront that this is the current position. If you're hiding it all the way up to the end, or sometimes not even including that, then it's just theoretical. So we don't put money in the ideas, we put money in the business, right? So that is a combination of idea, product, strategy, execution, growth. It is a combination of all of that. So that is an extremely important thing which I look at. Additionally, another thing which I look at is what kind of unfair advantage does that person bring to the table, right? So in today's day and age, technology is commoditized and lots of other things. You get very easy access to that. What is that unfair advantage which that founder has, which no other person out there has, right? What can you bring to the table which that person cannot bring?
Is it me because I'm in a hotel of Wi-Fi, or is it Harsh?
I think it's Harsh. Yeah, Harsh froze. I
I
think.
think it's the sea breeze next to his house.
See- Gary, you
Yeah.
tried to say something, but you are on mute. Harsh, are you
I
Gary,
back?
think,
you,
yeah, I'm back.
Gary,
Yeah, I'm back. Some technology issues, unfortunately. So, you know,
We can hear the breeze actually from the background. I don't know who that is, but yeah, we can hear that. I can hear that actually.
probably my mic. I'm not sure. Probably my earphone is making some noises. No idea.
All right, no worries, Harsh. Please continue.
Yeah. So as I was saying, I look at the founder's unfair advantage. Why should that person get the money and not someone else, right? That is the unique thing. What does he bring to the table? Is there some unique insight that he has, some unique deep expertise that he has, some access to special resources which he has, which someone else does not, or probably some patent or something of that sort? These are some of the important parameters which I look at when I'm, looking at a startup or investment.
Okay, cool. Thank you, Gary. Your thoughts, please, about uh, like early stage, pre-Series A startups are looking to raise funds. You're on mute, Gary. I don't know why you've been on mute.
Hello.
Yes,
Come on,
better.
I'm
We
here
can hear
now. How you doing? Yeah. So the pre-series A startups, early stage startups, is about the team. Well, what does the team look like? Have they been successful? Do they have the right grit? Are they, are they willing to walk through walls to be able to get the job done? So, the other thing is I look at passion, optimism, and visualization. I call it POV, because if you're not looking at the glass as being half full, you're probably not going to succeed. It can't be this negative stuff where, oh, I don't know, maybe I can do it, etc. You either believe in your heart and soul you can pull it off, or you shouldn't be in the game. And the other thing is, I'm not sure who said it, maybe Tushar or Anil, but traction. So if they have traction, that starts to become very interesting because and sometimes with the startups, and I've worked with thousands of them through my accelerator. Um, so through GVA and also Scopova, one of the things that I've found is that if they don't really have vision of where they want to go, if they don't really, if they're bullheaded, bullheaded, if you trying to give them advice about certain things, for instance, one startup, a direct example, uh, they don't have enough traction to be able to get the type of funding that they want to have, but they don't believe that that's true. And so instead of going to a top tier, they're trying to get a top tier VC to invest in them. They should go to a family office, other people that are more friendly, that are interested in investing in them. And they'll probably run out of money. They could run out of money because they don't understand that you need to go down through and figure out where not only money, but smart money. So there are smart family offices too. But sometimes they just don't do that. They're like, "Oh, I want a top tier investor," but top tier investors say they're not interested. And it's like going on a date with the wrong person. It's just that makes no sense. And you know, and and so setting realistic expectations. And sometimes it's really important, and we don't think about it, is God gave us 2 ears and a mouth for a reason. You got to listen. And sometimes these founders talk too much and they don't listen to what the investors have to say, and ends up killing them.
that's yeah, that's even right. Thank you so
I'm so
much.
glad Gary used my dating example again.
What's that? Your dating is
Um,
up. You like that dating stuff, don't you?
you remembered I mentioned this point a few weeks back.
Yeah, it's true. I mean, it is like a date, but you gotta like. There's times to push and times to not push, right? It's a paradoxical.
Exactly. Exactly.
All right, all
Not
right.
even. It's not even Friday yet. We're talking about the dating.
We
Oh
always have to
God.
be open for it.
Yeah, there you go.
Yes, all
I
of
was
you.
gonna make a comment. Are you asking?
Depends on the
Oh,
situation.
If it's
ooh,
raising money, I'm interested.
great, great. Thank you so much, Harsh and Gary. I think let's just have it from Vandana now.
Yeah, so there are a lot of factors that what we look into when a startup comes to us. First, we make their pitch deck presentable because the pitch deck has to be as per the market standards. We suggest them to have a video pitch deck. We suggest them to, uh, explain explain their startup in short and not take too much of the investors time. Also, we help them with their financial models and valuations. We look for disruptive models in tech, especially fintech, agri-tech, edutech, health tech, AI, robotics, and IoT. Not only this, we look for founders who have the drive within, are humble and down to earth. That means they are ready to pivot if we give them suggestions. They are ready to accept it, and they have the drive in them to run their show. They have some traction already, and they know who their customers are. If they have a CFO, an advisor, and a proper investment banker on board, we prefer those kind of founders as well, because they know then what they are doing. So I think we look into a lot of things. We had one case wherein the founder had put in his own money. He already had two successful startups, and this was the third one. And even though the product was not launched, he got funded because he had already achieved success before. So these are the some of the things that we look into a founder and into early stage startups as well. And rest
Yeah.
of the panelists have already covered a lot of points.
Okay, great points, all of you. I mean, that's about the startups, but like the investors and the startups relationship. But let's just talk about the startups from an investor perspective when they're approaching them first. Like, so how should they approach? That's a different way to approach investors. Not everybody is available, right? You can just go on LinkedIn, say hi, or send an email with a pitch deck. It doesn't work like that. So, what are the different ways to approach and network with potential investors? Anil, let's start with you.
So, see, with given times, every investor, is flooded with opportunities. I'm pretty sure not only from their home country, but also from, neighboring countries and international, market. You get a lot of opportunities. And, if it is a cold email, you need to be lucky, to get, attention of an investor. So I always suggest, try to get some references. As I gave an example, just short while that we were able to make a lot of references, for our portfolio company, and it clicked for them because every single investor, was willing to give his ear or her ear. So having a reference always helps. Cold email sometimes become difficult. Second, I think nowadays it's slightly tough, but otherwise, during good old days, we had a lot of opportunities to interact with potential investors in events, right? Networking events. I think those are the events which, helps in a lot of ice breaking because, you can just bump in and make intro and then take it forward from there, which I'm sure everyone is missing now, except Sony, who had good last whole week, and no column for next 21 days, but that's one. Third, I'm sure my friends on panel will also share a lot, but I'm a diehard fan of LinkedIn, which has actually helped connecting lot many interesting people. Some of them happen to be on industry side. So do make good profile. Try to do your research and reach out to potential investor, because LinkedIn is also one good platform for to get connected to potential investors. So I'll stop here, because I think we we'll have a lot of inputs from our friends, and we'll chime in more if something is left out.
Thank you, Anil. I think yes, you very rightly said that these kind of in-person conferences, that the one that I was in, I was visiting like Dubai, and there were a
Oh,
lot of
it's wonderful. We all miss.
yeah, those in-person conferences, events, even though it's quite big and people think it's you get lost, it doesn't necessarily is like that. You make a lot of business, you make a lot of
True.
connects, because isn't in person. It's probably 15 times more effective than sending
Very true.
an
It helps a
email.
lot. Very
It
true.
definitely helps a lot, and you get to meet people that you've seen only virtually. Like I met Karthik, he's one of the speakers on VCTV, as all of you know. I met him in person, so it
Wow.
was great to meet him in person as well. So that's a different flavor altogether. There's a different aspect to that, and it definitely helps, as Anil rightly said.
No, getting a
Okay.
FaceTime is very important, Sony. FaceTime really helps.
Absolutely, FaceTime. Yes. So yes, Tushar, over to you. What do you think? How to approach investors, network with them?
So, I as Anil said, we should definitely have a good LinkedIn profile, and apart from that, we should have a good internet profile also. Like somebody Google's our name, and the first 10 or 20 searches should throw up some blogs and some videos about what you are doing and what you are planning to do. And these are like very basic things, having a good website, and I see, the first time I had a talk with Gary here, and when I went to his profile, I was amazed. I said, my God, who I was really, I loved it. So that's an example. And there was a conference which happened, and one of the guys there, he just went to the investor, shared his visiting card, and this guy had stayed on the border studying what problems soldier faced and how could he apply technology to solve those problems, and then he created a technology company to solve those problems. So when he met the investor in that conference, he got the funding in 7 days. So
Oh,
what I'm trying to say is that you should have that thing in you. You should be doing some real stuff on the ground. Having a problem statement, solving a problem statement which is really forceful, and so I think for those things, they matter a lot. Apart from the hygiene factors like having a good internet presence and traction, as Harsh said, Gary said, traction is important because it shows that whatever you are performing at the end on the ground, and hence it also matters a lot.
yeah.
Right? Thanks.
Great, especially in a digital world today, because not every country is open for conferences. It's just Dubai, and I think Miami is open right now. Gary would probably know better. I think most of the people from Dubai, they flew to Miami because there's a big Bitcoin conference having. I think this week, or yes, or next week. So yes, but I think digital is still the way to go forward. Gary, your thoughts?
And thoughts about how to get to the investors? Is that what you're saying,
How to
Sonny?
approach? How to approach? How to network? How to get the business done?
VCTV. I got to tell you, a lot of the people that I met from my SPAC, I met from VCTV. The people
Right.
that, in fact, Irina Litchfield's going to have dinner with me on Friday night in Palm Beach
Oh, yeah.
because
I
of
met her as
VCTV.
well.
So it's really a hybrid model. I mean, the one thing is it is probably 10 to 15 times more effective to meet people in person. But the other thing, it's highly, highly efficient. Here I am in Florida right now, and we're all over the world. And for me to go around and travel that much would take a whole lot of time and a whole lot of money. So, that you become much more efficient. The key is how to use it wisely, having an online presence, making sure your LinkedIn profile is updated. And you got to write, by the way, write articles, because the first thing people do as soon as you get them online is they start to Google your name while you're talking to them. And so you need to make sure that you've got a lot of content out there that's on target, so that it makes it interesting on both sides. So I would say write as much as you can. You need to have an online presence. The other thing is you need to use those networking opportunities to be able to, it's always about the introductions. If you know one VC, they can do an introduction to a startup, or they can do an introduction to another VC. So you need to be able to use your network wisely. And you also have to be able to give, if you have something you can help. I just did it last week with an ultra high net worth individual who told me that he was looking for a somebody to do a crypto trading platform. And I know of a crypto trading platform it's a predictive platform out of Armenia. I was presenting down Armenia last week, and so it wasn't a big deal. I happened to be on the phone with the Armenian companies that I was presenting, and I got him on my phone and said, "Hey, I have something that might be interesting for you." So those kind of things. So look at for people's interest and basically connect the dots. So it's from my standpoint, it's a hybrid model, but most of the startups don't go out and they don't have much of an online presence. So when people Google who they are, there's nothing there. And so as soon as you do that and you're dealing in a digital world, you start to get even in the online world, because people, as soon as you see them, it's 5 minutes later, they're going to Google your name to see who you are, check LinkedIn. So make sure your LinkedIn profiles are updated. So that's the easy part of it. In terms of getting the funding, it's about a network and the connections. When it's all said and done, most of the money, and we're doing a significant raise right now. Okay. It's about the network and the connections, people who know you and believe in you and want to participate. And it's real interesting because they come to you. You don't have to come to them if you're doing a raise and they know that you're doing it. They want to participate. Everybody wants to have success, right? So it becomes a self-fulfilling prophecy. That's it. And if you're a serial entrepreneur, highlight your successes. Make sure that you talk about the success you have, because that's predictive of the future. If you had a couple of successes behind your belt, the probability of success is a lot better. That's it. Keep it simple, stupid.
Yes, keep it simple. As long as you get that funding, keep it simple.
Well, it's never easy getting funding. I have some of the projects I work on were with my partner. David Yang is a billionaire. I mean, we had to go out and raise money. Now, I got to tell you, the funny, go out and raise money with a billionaire. So you're going out for seed stage funding with a guy who's got $1 billion. You know how much different that is? I got to tell you. I'll give you a real story. So we went to the Silicon Valley, has a group. It's the top group of seed investors. So I take him into this group with me. And I forget, Silicon Valley Angel Fund. Anyhow, I take him into the group. We're presenting. They Google the name, and of course, he's famous. We're going down through this. They come up to him, but not to invest. They want him to join the group. I was going like, dude, man, you blew my pitch. But we did get funded. It took we actually got funded like 2 months later. I raised $3 million and $4 million within 5 months. So, but yeah, it was interesting. So use the network wisely. You're going to have a point of contact that has in to that particular venture capitalist, but you need to be able to map that and get to them, because a fresh, warm introduction really helps. So startups use warm introductions.
That's a very good example. Thank you, Gary, for sharing that. Harsh?
Yeah. So a lot of the important points have already been covered, right? A few elements which I would kind of like to highlight is the most important thing is to maintain ongoing relationships, right? What typically tends to happen is if you approach an investor or a VC like us, and we probably may not invest you in the first time, because we still want to build that relationship with you, see what you're doing long term. It's an ongoing kind of thing, right? What happens is if we say no at that point of time, the founder, he completely vanishes. Suddenly, 6 months, 1 year down the line, we hear back from him that now he wants to raise funds again. I have no idea what you've been doing for the last 6 months to 1 year. How can I invest in you? How can I trust you? So this is an ongoing thing, right? So a lot of the founders, they think it's like a one-time thing. It's an event. Working on a fundraising is it's like a one-time thing, but that's not the case. It's a summation of entire things that you've done in your entire career and your entire life, right? All the people that you worked with till date, the kind of relationships that you build over there, the kind of networks that you build over there, it all adds up when you're looking for fundraising. It's not just, at that point of time, I'm dealing with the investor, he's going to put the money into my business immediately. It never works that way. So if I want to raise funds, I'll reach out to all the people that I've worked with in the past. Some I have good relationships with, some I have sort of lukewarm kind of relationships with, but I'll work with them, I'll get more introductions and expand my network like a tree, right? That's how fundraising typically works. It's not a one time thing. What most of the times that happen is they'll ask me for funding, help us raise funds. I say them right now it's not ready, and then they completely vanish, and you have no idea what they are doing, what they're going to be doing, and suddenly 6 months, 1 year down, then they'll come up again. If you could just put, like every 1 month you put out a newsletter saying, this is the kind of stuff that we've been doing, this is the progress that we are seeing. You do that, so even if the guy has not put money right now, a year down the line, he would maybe be interested, because now, even by seeing your newsletter, I know about your business, I know about you and the kind of work that you've been doing. So this is a very important element which I think founders should focus on when they're looking to raise funds. So this goes a long way.
Yeah, I think, like you said, like you added, Tushar, would like to know from you your views as well.
So my views are that, of course, one doesn't raise funds only one time, and it's really a relationship with the entire ecosystem. And end of the day, when you become really conversant with the whole ecosystem, you realize that there are few active players who you see every time. And so you have to take it as a relationship, and not, as Harsh said, that you just do something, get some money, and then not bother about it. So that reminds me that one of the services which investment bankers and startup funding networks which they provide is actually a limited kind of due diligence on the background of the founder, and also the ground situation with respect to whatever claims they have made, talking to some distributor, and also trying to see whether they have the right revenue. I mean, I'm talking about these small ticket size fundings, and not the big ones like $1 million, where you'll have to do a proper due diligence, and a larger one. So and I remember I read Gary's articles, and I remember I used to write a lot of blogs, and definitely these things, they matter a lot. And if you are passionate about your subject, definitely you will be making videos about it, you'll be writing about it, and it shows. It not only shows in internet, but it also shows when you are interacting with the investor. And from the investor side as well, I would say that many times there is a social media post on LinkedIn. It was put up by a very prominent investor, and what he wrote was shocking. He said that I have told my analyst to just see deals and then throw them away, and the investments will be made actually by my relationships. So I the way he wrote it, I didn't find it very much in taste, because there might be quality deals which the analyst might be bringing to the investment committee. And so many times finding investments becomes a very running and chasing kind of game, which also is a quite, it takes up a lot of time of the startup founders. So it works both ways. So I would also like to request investors watching the show to actually have proper processes, and also make it easier for the startup founders. Thanks.
I think you're right. Yes. Thank you, Tushar. Thank you so much. Vandana, hear your thoughts.
So, in my initial very, very early years, we used to go for these business meetings where we were trained to have one-to-one meeting and face-to-face meeting to convert things. By and by, we built relationships with these funds by staying in the market for over 20 years, by, going on breakfast meets, dinner meets, tea meets, wining and dining with them. So I think when a founder reaches the right kind of investment banker who has the right kind of relationships with the funds, I think that helps them get funding very fast. Not only that, they know which fund to reach for which sector. Like, for instance, the founders don't know which fund to reach for which sector. Some founders are reaching, tech investors for a food deal, and food investors for a tech deal. But the investment bankers knows where to reach and how to reach them. And then, last year when the lockdown happened, uh, just by sitting on this chair, I closed 4 deals. So, my productivity increased because I could do 10 to 15 meetings in a day rather than running around on the road as well. And today also, I'm almost at the closure of 3 deals. This month we are closing 3 deals. And just by sitting here, by doing online meetings, we'll be able to close deals very fast by this way. So Latokan TV also has become like a family thing for me. I met a lot of people here, and I built relationships here. I could just pick up my phone and say, hey, look, I have this deal. Are you interested? So I think that really helps to close a deal as well. And there are a lot of things that are involved when one looks into a deal. In India, there are a lot of very good VC funds who are highly professional. They add in a lot of value when they come in. They bring with them a marketing team, a technology team. They open their network. And they are open to a lot many deals if it is presented and brought to them in the right manner. So I think it's just that the way we do things sometimes, and it's just that how we do things, how we build relationships really matters in this industry as well.
Right. It's about relationship for sure. Yes. Thank you, Vandana. That's a very key question that comes up all the time. How to negotiate term sheet? What kind of, no, I mean, yes, what should you need to consider? Because that's a key part of the fundraising, right? So let's just quickly go through your thoughts about some of your considerations that the startups should take into account for while negotiating a term sheet. Anil, let's start with you.
Oh, tough one. So, I, actually have a privilege of closing, over 100 plus deals, and probably at all level, seed, pre-series A, B, C, D, E. And as you move up in, value chain, terms, get more and more, stricter. But early stage, I have no hesitation saying, most of the, term sheet, almost 95% is very standard, pretty much standard. There's not much to negotiate, but from investor, or rather investee perspective, right? We are talking about startup, right? So
Yeah.
I think they should ensure couple of things, that sometime operation of company gets stranded if they don't have prior approval from investors, because there are a lot of affirmative rights which they land up giving up while signing up. So considering all those factors, I think they should be careful about that any rights which they are giving to investors shouldn't hamper their day-to-day operation, and shouldn't hamper their ability to raise further fundraise, right? So sometimes it becomes tricky. But these two factors, I would suggest that while terms are very standard, but at least have flexibility where you are able to function without any issues as far as your day-to-day operation is concerned. And also businesses need resources, and sometimes only because you don't have provision to raise money may hamper your growth. So these two factors I will suggest, and I'm sure I'll get more things to learn from my peer group. Thank you.
Yeah, sure. Tushar?
Yeah. So you're asking about how to negotiate a term sheet.
What
So
are the factors we need to consider? Yeah.
yeah, so once a lot of platforms like Y Combinator happened, so everything became a lot more standardized. And so if you actually go about negotiating each point in the term sheet, then you won't be able to get a bird's eye view of the kind of arrangement in which the investor and startups are entering into. And so in a term sheet, you should actually, from a startup point of view, you should fix up 4 or 5 broad parameters which you would like to hold, and then be ready to somehow negotiate and get those in your hand. And the other standard clauses, there are actually many which are there to protect this investor. And it's not really the fault of the investor that they have these legal jargons inside the term sheet. But matter of fact, these protections are needed because 8 or 7 or 8 out of 10 startups, as per the normal data, they don't do well. So in those times, the investor needs some kind of protection. And so how to negotiate a term sheet, I would say, just know your larger considerations, like commercials, like exit clauses, like any
Correct.
additional return which has been guaranteed or which is being promised to the investor over and above the agreed return. And the control related clauses which the investor has to have some sort of a control over the company. And those are the ones which you should watch out for. Thanks.
Yeah, great points. Great points there, Tushar. Thank you. Gary?
Yeah, so the main thing from my perspective is you need to have several investors that are coming at you at the same time that want to give you a term sheet. So if you want to get the best deal from an investor, you have 3 or 4 people that want to participate in the deal. It makes it a whole lot easier to negotiate terms. And of course you're going to negotiate the valuation, but again, every time, and also when you're doing M&A, you want to have multiple people coming at you at one time. So that's my my suggestion. And also with your investors, make sure you do due diligence on them. You don't want to just have money. You want to make sure you have smart money. Dumb money is not good. So
What's that?
dumb money is money that comes in that doesn't really understand what you're doing and is next to zero contribution to the project. Because when you raise money and you have those VCs on board, they become part of the family. And the key is you want people that can give you advice, right? Because it's not easy running I would use my board meetings to be able to share ideas. So and you want another somebody that's friendly, that has a vested interest in your success, that can help guide you. Sometimes people say they'll take money at any cost, but the problem is if there's no value add. Actually, I've seen situations with dumb money where they actually created a whole lot of problems for the startups. I heard of a situation directly that a startup, the person invested in an early round and then came back and said, I want my money back, but now since you're moving to the US, I want to double my money in my original investment. Now this is a startup. The guy put $250,000 in, double the money for the original investment, and I want 5% of the company in the US. And it was like senseless. Even to go down through and try to negotiate that with a extremely high net worth person was a waste of time. But the startup got into it, and it really actually screwed their business up because they had months they had to try to negotiate with this high net worth individual, and they shouldn't have had to do it. If they would have picked some group that had an understanding of their business, they would have been a lot more. But they took whatever money they could get. They didn't want to. They said, "I don't want to spend time raising money. I just want to find whoever comes in and has good terms. I'm going to take it." Well, that's what happened. So choose your investor wisely.
Interesting. Thank you, Gary. Thanks for sharing that example as well. Harsh.
Yeah, so Gary made a very interesting point, right? So if you look at most early stage deals, Anil was mentioning, most term sheets tend to be standard. However, there tend to be some outliers as well, right? The essence of the term sheet is to give some basic protections to the investor in terms of the capital that is put, right? In terms of preferred shares and other standard terms are there, like call up and those kind of options are there. But there are some draconian laws, draconian term sheets and draconian clauses as well, which the founders need to be extremely careful about. Because if in your first term sheet you agree to these kind of clauses out of desperation, that sets the tone of negotiation for your future fundraisers as well. Because the next investor is going to come, he's going to expect those kind of benefits as well. Because you already agreed to that in your first term sheet. So the second investor is going to agree to that as well. Is going to demand that as well, and you can't say no because you already agreed to that once. So it's extremely important to get your first term sheet right, because if you don't get it right, you'll completely mess it up. And coming back to Gary's original point for the finding the right investors, right? Just over the last month, I've been 3-4 startups kind of reached out to me for fundraising, and what had originally happened with them is in their earlier round they messed up so bad that they raised a few $100,000 for their business, but the investors, they took almost 50, 60 to 70% of their company, and now the founders are barely left with 20 to 40%, and now they're at a minority stake. Once this kind of deal happens, there's literally nothing much that the founders can do, and VC won't touch a startup of that nature because there's not much equity left with the founder either. And those early stage investors which kind of put the money in the beginning, they kind of completely gutted the founder and took as much equity that they could from the deal. They did not realize that in the longer run how detrimental that will be for the business. They thought that they were getting more equity so they'll get more benefits, but in the longer run, that's a complete recipe for disaster, and that's exactly what happened with them. So it's extremely important to be careful when you're negotiating those kind of deals, and you should not benchmark should be 20% at the most. You should not look at 20% or 25%. You should not look at diluting more than that. Unfortunately, those companies did, and now they're in a very bad shape because the investor won't. They are looking for funds right now. Investor won't put any more money, and outside investors won't look at them for any more investments. So it's like a vicious cycle. It's a circle of doom essentially.
Wow. So very, very startups who are watching today, please be aware of this. Thank you, Harsh. Vandana, over to you.
So, there are angels, there are HNIs, there are VCs. Now, everybody's term sheet is totally different from the other. Angels and HNIs, they ask for a higher equity dilution, and VCs have standard 10 to 15. Of course, what is it that they are bringing on the table? Are they adding any strategic value? When it comes to angels and HNIs, we have to do a lot of due diligence as to their money is clean money or no, and whether what is the value add that they are bringing on the table. When it comes to VCs, because everything is so open out there, we can easily check, and I know they come in with a lot of value add, and they are highly professional people, and the standard for VCs firms are 10 to 15%, which they take. For HNIs and angels, is what they take is anything above 20 to 35%. It's again depends on the founder as to what is the level of desperation that they have to go for which kind of term sheet. So we've also had founders wherein they have received 3 term sheets, and their due diligence has started. We have guided them how to do their due diligence. There were some flaws that came out in the due diligence. We told him to correct it. We did this for entire 1.5 years, and he didn't fix those problems, and all the funds backed out. So
Oh,
there are lots of things that go into a deal. Also, we have aggressive founders that want to box themselves in by giving a valuation. They start questioning the ability of the investors. They start questioning a lot of other things, and they don't want to, come on the same page and have a proper discussion. So these are a lot of factors. We are like fixed-headed about a certain kind of valuation, and you don't want to negotiate, and you box yourself up and then say, look, hey, I want this only, and if you give me this, I will not take it. So I think that all these factors are really important, and it's nowadays, every fund will has a different kind of a way how they propose a term sheet. So again, negotiations happen from term sheet to term sheet, startup to startup, and we investment bankers, our duty is to bring them on the same page and help a deal close successfully. That's why we are there. So I think that's my suggestions and thoughts here.
I think great points, Vandana, as well to this term sheet question. This is a tricky one, as Anil said very much rightly in the start. Okay, great. I think we are almost near the end of the show. Let's just take some quick closing remarks, closing thoughts before we wrap up. Anil?
So from India perspective, I think it's one of the best time to raise money. Lot many investors are now looking this as an asset class, and many startups are getting funded, right?
Right.
And with renewed interest from some global hedge funds, looking at investing in some matured company, more and more interest popping up. So considering the opportunity, if you have an idea, I think best time to raise money, and wish them all luck. Happy investing.
Thank you. Thank you. Harsh?
So in the early stages, at this point of time, it's kind of moderate in terms of the interest which is there. Definitely in Series A, Series B, it's absolutely phenomenal the kind of funding that is being done, right? But in the early stage, it's still a little difficult as of right now. So the best thing which I would suggest is when you're looking for funding, you need to have very solid, solid traction numbers in place. So solid, everything else should be in place. A solid founding team in place, all that is required, because right now if you're looking to raise like $500,000 or lesser than that, it's extremely complicated as of this point in time. So that is required. At the same time, you should be also capable of trying to keep it as consolidated as possible, right? Don't look at exuberant spending, trying to put too much money into growth, trying to get it to grow too fast too quickly, because right now the situation is such due to COVID. It's not really conducive to grow that quickly, right? You can't expect 10x, 20x growth in a single year. That's why you need to have a balance between pursuing growth, at the same time having some fiscal responsibility to ensure that you're not overspending and over splurging that the money that you're getting from the VCs. You need to have a balance of both.
I think, yeah, it's very important as well for startups to remember this key point. It's not your money. Thank you, Harsh. Gary?
Yeah, I agree with Harsh. So, part of the situation is really got to balance growth. And sometimes with some of the companies, they just want to throw money at it, the venture capitalist money, the investors' money, to be able to grow the company, and don't think about how to build a real business. So part of it's that, and they have what's called the irrational exuberance. They have such false expectations of where they are, that they need to get more feedback from the outside. It's like customer development, but you got to get investor development, understand what investors really think about your company, and use that as a guiding light. Because if not, you're going to not be around. I mean, it's simple. If you don't use that guidance and direction, so use the feedback, build your company up, look at what other similar companies have raised, go to the same kinds of investors that have had success. It'll make your life a lot easier. Make sure you have good advisors. I always go out, I call it the rule of threes. Generally, I have Rick Orloff, the former chief security officer at Apple, Bill Reichert, Guy Kawasaki's partner, and then one other person who's got some name brand recognition today on the board of advisors, because security and privacy is already going to come up. But if you start building it that way and building your company in that kind of vein, and you get that online presence and visibility, the probability of success goes up. But also traction. If you have some traction, it makes you feel a whole lot better about investing in that company, because it's not just throwing money in a well. There's some water in it.
Absolutely. Right. Thank you, Gary. Tushar?
Yeah, Sunny, I feel that, we have a benefit of being in this ecosystem, talking to investors, seeing deals, growing on the learning curve since 7, 8 years. And that's why, we are able to tell startups what they don't know naturally, because, they are doing their business, and not everyone is expected to be knowledgeable about this field. So that's where we come in. We help not only all the way in the term sheet, presenting yourself to the investors. We have good relationships with more than 300 investors globally, and we help in shareholders agreement and also the due diligence process. And so all this we do as a part of our passion, and as of course a part of the business as well. So my view is that investors are also maturing up. They are leaving a good part on the table for startups, knowing that the startups might lose interest, and the startup founders, there is a deluge of information and data out there, which is not always beneficial for the startups, the founders. So that's why we that's where we come in. I am Tushar Kansal, always available on LinkedIn by my name and my company name, Consultancy Ventures with a K. So happy to be on the show today. Thank you, Sunny.
Thank you, Tushar. Thank you. Vandana?
So there's a whole lot of process that one needs to go through with having the right kind of pitch deck, the financial model, the video pitch deck, having the right kind of investment banker, having a complementary team, having a traction. There's a lot of things that goes when we go for a startup funding. And, we as investment bankers have the right kind of connections with the investors. Also, we guide the startups in the right manner as to how to present your pitch deck, how to reach to the right kind of investors, how to close a deal successfully. And, naturally, it is the investors' hard-earned money, and it cannot be used for buying cars or treating cancer, etc., but it has to be used in the right manner. And I could be reached out on LinkedIn and my website, www.convanto.com. And thank you, Sunny. It is a great pleasure to see you after a very, very long time.
It feels like that. Thank you so much, Vandana.
Thank you.
So thank you, all of you. Thank you, Gary, Tushar, Anil, Vandana, Harsh, for being a part of VCTV today. I'm back. I'm back for good. No more no more travels outside of Singapore right now with this 21-day lockdown, obviously, inside a hotel. So nice, very good insights today on the show, and I'm sure all the startups are watching today. I've got a lot of information to take back, and I'll be back again tomorrow on another episode of VCTV. Till then, stay safe, stay happy. I'll be there tomorrow. Bye-bye.